Let's go to a morning must-read. This was so good from a few days ago. I thought we had to resurrect it today. The Laureate Stiglitz, you know what he's going to write about Greece, that it's the developed country's fault. Europe's last act from Project Syndicate, although the single currency was supposed to bring unprecedented prosperity, it is difficult to detect a positive effect for the Eurozone before the crisis. In the period since, the adverse effects have been enormous. Jeff Rosenberg with us with BlackRock, and the professor's major issue here on a network basis is all of the benefit was convergence, and we've gotten the opposite, which is divergence.
Yeah, you know, there was some benefit at the beginning, but it was, you know, the Greeks basically, for example, or all the periphery basically got access to low-cost funding. The problem is, what did they do with the low-cost funding? Right?
Yeah.
We forget how we got into this crisis. Is there was a binge of debt issuance and leveraging because you could borrow at rates that weren't really reflective.
And Brendan, to you living there, did it make a deal that it was a euro versus a Deutsche Mark in Germany?
Well, no. I mean, the year the euro was instituted, actually, it was called the Teuro, which is a combination of the word teuer, German for expensive, and euro. So, I mean, all that the Germans saw at the time was that things got more expensive. But, you know, we're talking about the periphery getting more money coming in. Where did that money come from? It came from other euro-denominated countries. It came from Germany. It came from France. And so there's sort of, when you talk to Germans about this, they use the passive voice. This money flowed into Greece. They gave money to Greece. They got their return on it. And that's something that's forgotten when we look at the background of the crisis.
Yeah, yes, it is. I mean, but it wasn't just other countries. It was global investors. Everybody basically played the convergence trade for a very long time. And that fueled a lot of easy credit and easy borrowing. And there wasn't really, there's a breakdown in how bond markets are supposed to function, which is as disciplinarians to signal what is the proper credit risk of the country and then charge appropriately. Well, we all believed that once you were in the Eurozone that you had German-like credibility to you. And so you got to borrow at German rates. So it turned out that wasn't really the right rate.
So what are European corporations and what is European corporate debt signaling?
Well, the corporate debt market is a very different part of this. I mean, the more recent story is corporate debt have been beneficiaries of ECB QE and the collapse in interest rates and have really been able to take advantage of the low interest rates on the government side to really refinance a lot of debt. You've had a big issuance come into the European corporate debt market from global U.S. issuers taking advantage of very low interest rates. That's the consequence of the most recent story in terms of low interest rates in Europe for corporate borrowers.
I think to Jeff and Stiglitz's point, you know, really the economics of this have never really worked out of the euro. It's never been clear. I mean, you're seeing that right now in the reporting that Bloomberg has on the German government. There's a breakdown between the parts of the ruling party that want to treat this as a political problem that must be solved and the part that sees it as a financial problem with discrete financial consequences.
Well, you know, the economics of the Greece tragedy, drama, whatever you want to call it, have been very clear for a very long time. What we're dealing with is essentially a political issue. Do you want to be in? Do you not want to be in? And what are the political consequences of an exit? And how do you want to manage that? The economics are very clear that Greece really needs to fundamentally change its economic structure if it's going to maintain membership, and that's a democratic choice.
Total of Paris, 1.6% on 10-year paper. That's amazing.